Ladies and gentlemen, good day, and welcome to the Q4 and FY25 earnings conference call of Yasho Industries Limited, organized by MUFG Investor Relations. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Masoom Rateria from MUFG. Thank you, and over to you, ma'am.
Thank you. Good evening, everyone, and thank you for coming to Yasho Industries Q4 and FY25 business call. Today, we have with us from the management, Mr. Parag Jhaveri, the Managing Director and CEO, along with Mr. Chirag Shah, the CFO. Before we proceed with the call, I would like to give a small disclaimer that the call may contain certain forward-looking statements which are based on the business opinions and expectations of the company as on today. A detailed disclaimer has been given in the company's investor presentation. I hope everyone had a chance to go through it, which was uploaded on the stock exchange. Now, I would like to hand over the call to Mr. Parag Jhaveri. Over to you, sir.
Good afternoon, and thank you everyone for joining us for today's results call for the quarter and year ended 31st March 2025. We truly value your continued support and interest in Yasho Industries' performance. As we discuss our financial and operational performance for Q4 and FY25, I would like to emphasize our unwavering commitment to maximizing the value for our stakeholders. Joining me today is our Chief Financial Officer, Mr. Chirag Shah, who came on board with us on 18 February 2025. We are pleased to have his insight and leadership as part of our team. I hope all of you have had an opportunity to go through the financial results and investor presentation for Q4 FY25, which are available on the stock exchanges and our company's website. Our performance has remained stable, marked by year-on-year volume improvement of 20%, which has driven a top line of rupees 668 crores for the year through enhanced sales volume. Despite facing pricing pressures and volatility in recent quarters, we have successfully mitigated these challenges through a more efficient product mix, resulting in an EBITDA margin of 90% for the quarter, supported by economics of the scale. Our gross margin improved significantly to 43.1%, up from 36.9% in the same quarter last year. PAT for the quarter was rupees 5 crores. During the year, we commenced operation at our new production facility in Pakhajan, currently operating at approximately 50% utilization. We aim to reach 70% utilization by the last quarter of FY26. We have raised rupees 125 crore through the issuance of equity shares on a preferential basis. This new funding will strategically invested in promising opportunity within the industrial segment and to reduce long-term debt. In this quarter, our US warehouse became operational in March 25, enhancing our ability to service the US market more efficiently. This is a strategic move to localize supply and improve customer responsiveness. We are also focusing on reducing our debt and bringing the debt to EBITDA ratio to 3.5x by FY26. Let's talk about some of the financial highlights. Q425, our revenue from operation for the quarter reached 182.8 crores, reflecting a 8% year-on-year growth, largely driven by significant volume expansion. Exports were a key contributor, accounting for 67% of our total revenue. We successfully preserved our margin and our focus on effective inventory management alongside an optimized product mix enable us to achieve an EBITDA of 35.6 crore, resulting in EBITDA margin of 19% for the quarter. In terms of segment-wise contribution, industrial sector represented 85% of the revenue, while consumer for 15%. For the year ended March 2025, our revenue from operations totaled rupees 668 crores, reflecting a robust 13% year-on-year increase. EBITDA for the year stood at 118 crores, yielding an EBITDA margin of 17%. The profit after tax for the year was rupees 6 crore, affected due to depreciation and interest of a new Pakhajan plant. Segment-wise, industrial chemicals contributed 83% of total revenue, while consumer chemicals contributed 17%. On geographical terms, export around 67% of the total revenue and domestic market contributed rest. Our outlook. The global economy remains uncertain amid evolving geopolitical tension and policy shift impacting the chemical industry. These uncertainties are expected to drive price volatility across both raw material and finished goods, creating a highly dynamic market environment in 2025. Meanwhile, India is gaining traction as a strategic partner with policy advantage that enhance its position in the global supply chain. With rising global interest in partnering with India, significant opportunities are emerging. We are well positioned to capitalize on this evolving landscape. Because of this factor, the company is optimistic about achieving 40 to 50% revenue growth in FY26, supported by increased capacity utilization, improved logistics, and continued focus on high-margin value-added product. In conclusion, FY26 was a transformative year for us. We laid the foundation for long-term sustainable growth with major investment in infrastructure, global reach, and technology. Looking ahead, we will continue to focus on enhancing capacity utilization, driving innovation, improving product mix, and optimizing cost, all of which are aligned with our strategic goal of delivering superior shareholders' value. Our commitment to creating a long-term value for our stakeholders, coupled with prudent financial management and strategic initiatives, will be instrumental in sustaining our growth in coming years. Thank you again for your continued support and trust in Yasho Industries. We are now happy to take any questions you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aman Thadani from Solidarity Investment Managers. Please go ahead.
Hello, am I audible?
Yes.
Thank you for the opportunity, sir. So perhaps my first question is, since Pakhajan, we are operating at 50% utilization on a monthly basis now, so has the higher utilization started getting converted to sales? And have we achieved EBITDA break-even on a monthly basis at Pakhajan?
As long as capacity utilizations come, yes, it has achieved almost on a sales side in month of March, what we anticipated. And we hope that we will be able to increase that sales from Pakhajan in 25-26. Also, yes, Pakhajan has, with that utilization, Pakhajan has a break-even, and it has achieved that.
Okay. And just one clarification from your opening comments. So the capacity utilization target for FY26, so sir, is that 70% for the entire year, or is it for just the last quarter of FY26?
No, 65 to 70% for entire year, not for the last quarter.
Okay, got it. So sir, just wanted to understand, given the global environment and the challenges that we are facing, what is sort of driving the confidence behind this 70% utilization in FY26?
That's a good question. We were expecting a lot of approvals, lot of business in last year. We are running behind almost by 2 quarters, but I think we have come to the end of that challenge of approval, getting a business. So business started converting into the business intent started converting into the business, actual business. And that gives us confidence to give a policy guideline of achieving the 40-50% of top line growth. Also, as I said, that India is in a favorable position globally, so we do see a good opportunity there too.
Understood, sir. And sir, what would be your sense around EBITDA margin at 70% utilization, or maybe for the blended company in FY26 if you don't want to split it by 2 facilities?
Well, as of now, we don't want to increase the guideline because there are a lot of uncertainties on the pricing front because of the geopolitical issues. So we still want to maintain between 17 to 19% EBITDA margins for the FY26.
Got it, sir. And so my next question is, as I understand about the business, raw material cost is sort of pass-through in nature in our business. Currently, we are holding higher than usual inventory, and against a large inventory portion, there might be no customer orders. So, sir, what is your sense around margin impact if, let's say, the raw material prices or the selling prices were to decline by 10%?
I didn't get your message clear because there's a lot of noise. Can you just repeat it, if you don't mind? Sorry.
Sure, sir. Sir, am I audible now?
Yes, but there is some disturbance coming from your side. Hello?
Is this better, sir?
Yes, much better.
Okay, sir. Yeah. Sorry for that. Yeah. So, sir, as I understand about our business, the raw material costs are sort of actually passed through in our business. So currently we are holding higher than usual inventory, and what I'm assuming is against a large portion of the inventory, there might be no customer orders. So wanted to get your sense around margin impact if, let's say, the raw material or the finished good selling prices were to decline by, let's say, 10-15%.
We have done that analysis of 5% up or 5% down, how does it impact? But it has a very minor impact as we have a quarterly pricing with our customer. So we don't see a major impact. We are able to pass on if there's a cost rise or if there's a cost reduction, both the way we are able to pass it on to the customer.
Okay, got it, sir. And so just a follow-up question on the inventory. Since it's a bit higher than the past 5 years average, sir, what is sort of the plan of action to get inventories to more normalized levels, and by when do you see the inventory days normalizing to the past averages?
I think it should be come by the September quarter.
Got it, sir. That was it, sir. Thank you so much. I'll get back in the queue.
Thank you.
Thank you. The next question is from the line of Ashwini Agrawal from Demeter Advisors. Please go ahead.
Good afternoon, Parag bhai. Congratulations on getting Pakhajan up to 50%. So could you give us some color on the kind of contracts that you are now processing at Pakhajan? Because these were supposed to be large global customers, and barely 4 or 5 orders would fill up the entire Pakhajan from what I understood. If you can give some color as to what kind of client, is this one of those large orders or is this a series of smaller orders? What kind of orders are these?
Well, we have certain large long-term supply orders, but orders comes every quarter on quarter, not one go. So yes, there are a few orders, few customers who has come on board which need a large quantity on a regular basis. And there are some customers who have been added who are negotiating every quarterly. So that is a both way. There's a very few which is a spot customer, but our focus is to work with a large committed customers, and that is what now getting converted into reality.
And what is a large proportion of Pakhajan output going to the US, if I may ask?
No, it go across the globe, so it's not only the US.
Okay. And sir, you've opened this warehouse in the US, which means that you will be doing a stock and sale method of selling. So, in this situation where some tariff imposition is quite likely, what is your sense? I mean, how much of it would you be able to pass on as a cost? How much of it would you need to absorb? Any thoughts?
Well, as you know that the USA don't produce all the chemistry. So the chemistry which they don't produce, we are able to pass it on, or some of the places we say that we just started our relationship, so we are already charging with the lower side of our thing. So we generally pass it on to customers. And so far, we have seen that customers are accepting our new US prices. Some segments, customers we have seen, they are just wait and watch. They also want to see the overall US economy, how they perform. So someone has a little bit slowed down, and some are doing very well. So there is a mixture of mixed message we are getting from there.
Okay. And the last question on a Concall basis, what percentage of the revenue in March 25 would have come from the United States?
It's about gross level combined revenue must be over in the 20 to 22%.
Okay. That's all I have. Thank you, sir. I'll come back in the queue for more questions. Congratulations again.
Thank you.
Thank you. The next question is from the line of Karan from Keynote Capital. Please go ahead.
Thank you for the opportunity. So my first question is, what is the current status of approvals from your customers? So are they expected to come in Q1, or is there any change or delay in the timeline?
So already they are ordered there in place. That's why we are giving you the guidance of utilization of 70% on a 60 to 70% on a FY26 basis.
Okay, understood. And the next one is, what will be the current blended realization for all products on a company level?
I think you are talking the per kilo, or what you are asking? See, our gross margins are in the range of about 42%. 42%. Blended gross margin is.
Realization, revenue per kg or revenue per ton?
Per kg should be about 400 rupees a kilo average pricing, somewhere in that range. 375.
Understood. And lastly, if you can provide the guidance on what will be the gross debt position for FY26?
We have already given the target of 40 to 50% growth for FY26 from the current base.
Gross debt position for FY26.
See, current debt is in the range of about 470 crores. Okay, current debt, and we expect that to come down to somewhere in the range of about 450 crores.
Okay, understood. That's it from my side. Thank you.
Thank you.
Thank you. Ladies and gentlemen, in order to ask a question, you may press star and 1. So the next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good afternoon, sir, and thanks a lot for giving the opportunity. Sir, on the related question to the earlier participant on the US tariffs, so, how should we think about this business? Because this is like 20-25% of our overall revenues. Were we expecting this percentage to go up significantly upon full operationalization of Pakhajan, or was it expected initially to be at the same level? And secondly, is China also a major supplier to the US market, or, because most likely the Chinese tariff should not be lower than Indian. So will we get any benefit, or how do we assess this situation, sir?
I have already made a comment that India is in a favorable position to do a business globally, and we do see some traction on that side. I can't quantify how much that will really relate to FY26, so that will be difficult. It's too premature to make a comment. We are just beginning of the crisis, and let's see how the crisis unfolds.
But is China a major supplier as well to the US for the kind of chemicals we are planning to manufacture in Pakhajan?
China is everywhere. China has every product China produces. It's nothing which China don't make it. So I don't have too much insight about the China presence or not on that side. But there must be Chinese producer. There are producers which we see them in a non-American market, so there has to be in the US market too. I won't surprise.
Okay. And secondly, so this inventory has gone up a lot. So, I mean, if you can share some more color, I mean, what was the requirement to raise it significantly by almost 130 crores in this financial year?
Sorry, what was?
The inventory has almost doubled, sir, YOY.
Yeah, inventory has gone up because we need to produce certain quantity to get approved at customer, and they need a manufacturing data. They need actual data, not something. So to validate the product at customer, we need to produce a larger volume, and that's the reason inventory has gone up. And we are expecting the inventory to come down into the natural time by September.
Okay. Because finally, on the pricing of both the RM and the finished goods, so I guess, these had come down not just for those chemicals, but in general in the chemical industry. But are you seeing some sort of pricing go up going forward, or do you expect the pricing to remain at the lower level that we have been seeing in the last few quarters?
At the moment, we see the price subdued. We don't see a significant increase in any prices. Some prices we see the increase in India also, but globally we are not seeing that trend yet. So our projection is purely based on the current prices, not any upward or any revision on that. So the water projection we are giving you today based on the current market price.
Understood, sir. Thank you and all the best.
Thank you.
Thank you. We'll take the next question from the line of Manan Shah from Moneybee. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations on achieving 3% at Pakhajan. My question was relating to our raw material sourcing. What is our dependence or what is our domestic procurement versus the imported for the Pakhajan facility? And in the imported part, what is the reliance on China?
Good question. And you want to specific to Pakhajan, right? So for specific Pakhajan, almost 70% is a domestic, 30% is import, and of that 30% maybe 10-15% come from China.
Okay, so even this 10-15% we can source it from other location if need be, right?
Yes and no.
Okay. Understood. Sure. Thank you.
Thank you.
Thank you. The next question is from the line of Prathamesh Dhiwar from Tiger Assets. Please go ahead.
Yeah, sir, just one question on the debt side. So as we have given the visibility for FY26, so just wanted to know what will be the debt levels in 27 and 28.
Well, I have honestly not done work on a 27 and 28 as of now. We just we have finished our budgeting for 26. So 27 should be in the range of about 400 crore. That kind of repayment will be scheduled will be there for us to repay the loans.
Okay.
Yeah, 28 I don't have data of the answer I can give you. If you want particular information, just drop an email and Chirag will be able to give you all the information on that.
Sure, sir. Thank you so much.
Thank you.
That's it from my side.
Thank you. The next question is from the line of Anirudh Shetty from Solidarity Advisors Private Limited. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just some follow-up questions on my end. So in our guidance, do you think we can hit our full utilization of, say, 90% in Q4 FY26?
I think so. If we hit 90%, then only we will achieve 70% as an overall.
Okay. Do you see possibilities? You mentioned that our EBITDA margin band is 17 to 19%. But in Q4 FY25, despite Pakhajan being only at not even 50% utilization for the full year, we are still hitting 19% EBITDA margin. So, in 2026, we should see more fixed cost absorption. So, what is the possibility of doing actually higher EBITDA margin compared to a band of 17 to 19?
Let me be a more cautious approach rather than taking a highly overconfident approach. So we want to remain firmly on grounded, not to give a wrong guidance, which cannot be fulfilled. So achievable guidance on a longer term with the current market situation and current geopolitical situation is wiser to give in 17 to 19%. If we see that we are able to pull out all kind of things and we will be able to improvise, we will revise our guidance by the media. But for the beginning of the year, I want to be cautious. I don't want to go highly into that overdrive.
Got it. Our inventory, you answered the question about it improving. Just wanted to understand the inventory that's there today of, say, 260 crores. Is it the build-up? Was it finished goods or was it work in progress? What was the nature of that?
It's a more of a work in process and finished goods, both. More of a finished goods, I can say that, rather than work in process.
Okay. And the nature of this finished goods, is it largely customer specific or is it fungible across customers? And
we don't have any customer specific inventory. We have all the standard quality what we supply across the globe. We don't make customer specific.
Got it. And by September, when things normalize, do you think you can hit your, in the past it has been 70 to 80 days of inventory that you all hold. Is that something you all can get to, say, by September or by the end of the year?
That is what we are expecting to achieve in the longer run. We have to achieve that for a better management of the cash flow. Otherwise, if we stand that we need to borrow and we don't want to borrow any money. We want to reduce our debt. So we will be working hard towards that, to ensuring the inventory levels are well within the limits.
Got it. Thank you for answering my question.
Thank you.
Thank you, sir. We'll take our next question from the line of Manan Shah from Moneybee. Please go ahead.
Yeah, hi. Thanks for the follow-up. In the press release, you also hinted towards some marginal capacity expansion for some products where you're seeing good growth opportunities. So is this for the Pakhajan plant and the existing products?
It will be for a Pakhajan plant. Yes, it will be for Pakhajan plant. We do see some good traction in some of our products where we built up the capacity and we see good forecast and a good opportunity, so we decided to do some incremental capacity expansion.
So what will be the capex outlay for this year?
For this year, we have said about between 75 to 100 crore.
And this will be primarily for new capacity at Pakhajan?
No, something also will go for the R&D facility.
Okay. And for the existing sales for Pakhajan, what percent would be to OEM and what percentage would be to aftermarket?
We don't have any OEM customer as of today.
So the entire sale has gone towards aftermarket only?
I can't comment that where my customers are. If they have a OEM approval, I have no idea.
Okay. Thank you.
Thank you.
Thank you. The next question is from the line of Shubham Jhawar from Dexter Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Am I audible?
Yes, dear.
Yeah. So my first question is on the gross margins. This year we have seen the gross margins improve quite a bit to 43% compared to 37% last year and the year before that as well. So are these gross margins sustainable going forward, or what are the gross margins that we should expect on a sustainable basis?
Sustainable should be about 40 to 42%. Okay, that's where 40 should be more reasonable margin. One should look at it as a long run business. There are certain products, sometimes you get opportunity, specific product portfolio runs niche product, yes, that gives you a spike in a margin. But otherwise, as a long run, working 40% is the right one.
All right. And so my second question, apologies for the repeated question on inventory. I just wanted to understand a bit more specifically. In November of 2024, when we spoke on our earnings call of Q2 of FY25, we were expecting that we would be hitting our working capital days of 110 by March of this year. But currently our working capital is more than 200 days, right? And like you mentioned that our the extended inventory is due to the products that we have to keep for customers' approval. So my understanding is that the customers' approval will be ongoing for FY26 as well, right? Because our Pakhajan would be commencing like more than 50 to 60% of utilization. So like how confident are we that we would be able to do normal inventories by September of this year?
We are very, very much confident to achieve that, because a lot of business which is now started coming in, which is going to take care of my inventory. And that's what I can say, that we are very, very confident that by September, inventory level will come down drastically. Yes, 110 is our target, 110, 115 days as an overall control should be target one, should be achievable by FY26 definitely.
All right, sir. Yeah, that was it, sir. Thank you so much. All the very best.
Thank you.
Thank you. We'll take our next question from the line of Ashwini Agrawal from D-Meter Advisors. Please go ahead.
Parag bhai, thank you for the opportunity again. So two questions. One is, with this US dollar volatility and US dollar having weakened against all global currencies and oil prices falling at the same time, how do these moving parts have an impact on your profitability or your pricing?
Anirudh, that's the first thing is that we have a lot of natural hedge. Our exports are a little bit higher than the imports. Not much, about 5-10% higher than the imports. So that gives a lot of comfort zone, the volatility. We do hedge time to time as per our forex advisors when they see the right moment. So I can say that we have been taking care. Our CFO himself put his personal attention day in and day out on the forex side. Because as you said that we are very much heavily dependent on forex volatility. It does. If we don't take care, it will impact our profitability. So yes, we do take care of it very minutely on that, and somehow we are able to navigate it, and we have not lost money or we have not lost an opportunity due to this forex volatility.
And so softer crude oil, how does that impact?
Crude oil has no impact. Somehow, it's more of a demand supply than the crude oil today in current scenario. We have seen some prices going up and some prices down purely due to the demand supply. Okay, so crude oil don't have much impact. Because of that, no prices change. Nobody is impacting. If the price has to go up, they give you 10 reasons. To go down also, they give you multiple reasons that look, we are not able to justify the sustainable operations, the break-even is not there. So we buy commodity. We don't have much control on that, against which we sell the specialty.
Okay. And so the other question I had was that in your earlier comments, you mentioned that the 75 to 100 crore capex this year, a large part would go towards R&D, if I heard you correctly. So should I assume that the capacity expansion that you were planning for Pakhajan is not on the agenda for fiscal 26 and it will happen later? Would that be a right interpretation?
No, that I didn't say. I said that some of 100 or something will go for R&D. Definitely there will be some capacity expansion will be happening at Pakhajan, because Vapi we don't have any room there except we only do the product mix change. That's only best thing. So Pakhajan will be you going to utilize the entire capex. Part of it will be for R&D, but the major part will goes towards capex for the increase the capacity.
So will the capacity, you had all these sort of your existing shed can take up at least 50-70% more capacity. Would this money be enough to fill that entire thing out?
Not entire. We are not filling entire spare capacity in our existing building. So after even that, there will be some space will be left, luckily for us. So yes, two buildings are capable enough to pull out 26. In 27, we'll think about the additional building if we see a further opportunity.
Okay. Thank you, sir. All the best again.
Thank you.
Thank you. A reminder to all participants, in order to ask a question, you may press star and 1. The next question is from the line of Varun from Scaniva Capital. Please go ahead.
Good evening, and thank you for the opportunity. I think in the first quarter of FY25, we've spoken about 3 or 4 newer products, which is having an addressable market size of around 5,000 crores. So I just wanted to know any our work on these new products and just an update on it.
We did talk about that, and for that, out of that 4 product plant is for capacity we have already installed. 5th product we are working on is still work in progress, and that could be the product which will bring it online with the research capex.
Okay. And with the phase 1 of Pakhajan, we've utilized only like 10% of our big land holdings. So after finishing the phase 2 expansions also at Pakhajan, probably in FY27, what percentage of land would be used?
Well, right now we are using about 50% of the land, not 10%, 50% of the land we are utilizing. Okay. And the current capacity we are going to do it in an existing building. So 27 we are not given thought yet how much we want to expand, what is the cash flow and how we can raise fund, everything to be come in our picture. So it's too premature to talk about the phase 2 today.
Okay. Thank you, sir. That's it from me.
Thank you, Varun.
Thank you. The next question is from the line of Shaurya Punyani from Arjav Capital Partners. Please go ahead.
Hi, am I audible?
Yes.
Sir, just one question. So you are targeting around 40-50% growth this year. So can we continue this momentum like in FY27 also?
I think so. We are very much confident about that because there will be enough for
additional growth, sir.
There will be enough space for further growth too. And as we are also looking for new capex, so that will only kick in 27, not in 26. So capex will be completed by early Q4 of FY26. So the impact will be seen only in FY27.
Okay, sir. Thank you.
Thank you. The next question is from the line of Majid from TradeWalk Research. Please go ahead.
Okay, sir. Thank you for the opportunity. Am I audible?
Yes, Majid.
Yes, sir. So my first question, sir, is so the capex is going to come live without FY27, right?
Yes, impact will come only in Q1 of FY27.
Okay, sir. Suppose that, like, what is the possibility of the fixed asset terms that could be? Can it maintain the same momentum of 3 to 4 times fixed asset terms, or Like,
no, it will take a while because, see, we have spent a lot of money on our infrastructure capex. So what we are of 480 crores, we have spent almost 240 crores on infrastructure capex. So that will take a while. So at least we expect the 3 returns only by FY27, not before that. Earliest could be FY27, earliest, or it could roll out to FY28.
okay. So then what about the working capital days? Is the working capital days going to remain the same, or will there be an increase?
Right now, working capital days are very high due to the high inventory, which we intend to bring it down by end of the FY26 by 110 days, 115 days. That's our target.
110 to 120 days.
110 to 115 days, somewhere in that range.
Okay, sir. So what about the capex guidance you're looking going forward? Any sort of additional capex or?
FY27 you're talking or FY26 you're talking?
26, sir. 26.
FY26 I already said we are doing capex of 75 to 100 crore this year.
75 to 100 crore. Okay.
Yes.
Okay, sir. And what about finally, my last question is about what about the volume and value growth? Any sort of improvement can be there? Or,
we have already given a guidance for 40 to 50% increase in the revenue. And plant utilization at 60 to 70% at Pakhajan. So at a company level also it will be more than 70%.
Okay. So majorly it comes from volume.
Yeah, obviously, the growth will come from volume only. The way volume grows, then only the revenue will grow.
Okay. Okay. So thank you for the opportunity.
Thank you.
Thank you. We'll take our next question from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
So just one more question on the this year's capex.
Too low. Can you be a little bit loud?
Hello.
Yes.
Yeah, sir. One question on this year's plant capex, which you mentioned is 75 to 100 crores. And so, sir, since this is coming in Pakhajan, and as you mentioned, this is already, excluding infra capex, we have put in 240 crores, and this is coming under existing shed. So even if it is 75 to 100 crores, it should be a major expansion, right? I mean, why are we calling this as a minor expansion?
Because we are also going to create our R&D facility there, and that will take a chunk of money. So at least 30-40% of that money will go towards R&D.
Okay. And in capacity terms, sir, how much approximately?
I think now we are not keen to give you the overall capacity. We will always give guidance on the revenue side rather than a capacity of installed capacity. So hence, you must have observed that this year investor presentation also we have removed the capacity chart. So we are not comfortable to give the capacity what we have. Rather than we will be more happy to talk about the revenue side and also performance side.
Okay. This 40-50% is going to R&D out of this year, sir?
I said 30-40. I didn't say 40-50. 30-40.
30-40. Okay. Thank you.
Thank you, dear.
Thank you. Ladies and gentlemen, in interest of time, we'll take our last question from the line of Manan Shah from MoneyBee. Please go ahead.
Yeah, hi. Thanks for the follow-up again. Sir, you mentioned that you're looking at a capex of roughly 75 to 100 crores, and on the debt side also you mentioned that you're looking to close the year around 450 to 470 crores sort of a debt. That would mean that you would need roughly 200 crores of cash flow. But the numbers that we are talking, I believe will generate maybe close to 160 crores sort of an EBITDA, and the debt servicing we would need roughly 50 crores. So that would leave you only with around 110 crores of cash flow.
Why need 200 crore? Manan, I don't think we need 200 crore. We need only...
You mentioned around 75 to 100 crores, and current debt on our books is around 550 crores.
Oh, I said current debt is 470 crore.
Sorry, sir?
Okay. Now this we are talking about banking. Okay, yeah. Okay, fine. See, what we are looking at we will not require, once the stock level come down, our working capital requirement will go down, and that will release a lot of cash from there.
But sir, on an expanded sale, if I assume you come down in terms of days to 110 days, your absolute inventory requirement will still be near to 40 to 50 crores.
That's what we... Less than 200 crore, if you count.
Okay. So you are expecting to release around 40 crores from inventory?
Yes.
Okay. So, thanks.
Thank you.
Thank you. Ladies and gentlemen, this was our last question. I would now like to hand the conference over to the management for closing comments.
Thank you very much, everyone, to join for today's call. And we look forward to seeing you guys in the next quarter. Thank you. Have a good day.
Thank you. On behalf of Yasho Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.